Continuing on with the series, we have our next 5. One is a defence contractor, BAE Systems. We have 2 banks, Natwest and Barclays. Then we have CRH, a massive concrete producer. And we have Vodafone, a telecoms communication company. Right, let's jump into them and see how they're all doing. Okay, so BAE Systems off the bat, ticker symbol BA, traded on the London Stock Exchange, of course, price £8.34, market cap at 25 billion. They have had a rocketing year. Obviously, the conflict in Ukraine has completely, threw earnings through the roof for the likes of defence contractors such as BAE, who produce everything from tanks to planes to aircraft and aircraft carriers. I think they designed the HMS Elizabeth, if I'm not mistaken. I think I'm correct on that one. So 57%, you can see trading from £5.31 to a massive gain of £8.34 in a year. I'm sure a lot of people were holding on to this stock as they were fantastic dividend payers before anything in Ukraine happened, and since then they've obviously went from strength to strength. Really, really top dividend pair, 5 out of 6, and their financial health has always been quite good. Value sits at 2 out of 6 at the moment. Future, 3 out of 6, and past performance, another 2 out of 6. No risks, they pay a reliable dividend, and they are forecast to continue to grow into the future. Right, let's have a wee nosy here. Their valuation. Right, PE ratio is 18.7. Some of their competitors, is it their peers, senior? I'm not too sure if any of those stocks are defence ones, but we'll continue on down to my favourite thing. Here it is. So on a discounted cash flow model, they are currently 1.6% overvalued, which, they were trading about £5, not that long ago, less than about 8 months ago. So that is something to definitely bear in mind. I know a lot of people are waiting to see if the stock goes down a wee bit. But again, all depends on the general peace and stability in the world stage to see if this stock would indeed do that. Down to future growth. They are forecast to grow. We can see into 2022 December. I think that's when their earnings come out. Obviously, it'll be another massive jump because there's been renewed weapons being sent to Ukraine from a lot of Western nations, and the UK in particular, where BAE operate. Past performance, we can see that they weren't doing too bad 2016, 2017. They just had a spike into 2022 in revenue, obviously again due to that. Financial health. They score everything except their long-term liabilities, which is a bit strange because it looks like it covers it pretty well. We can see here that their debt to equity has smashed it in 2022. Their debt's well covered by operating cash flow, and again, interest payments are also well covered. We can see their dividend, which everyone loves, is 3.07%, which puts them industry average, top 25%, they're not there, but it's forecast to continue to grow. Their chart, this has been brilliant in the sense of they have increased their dividend per share for at least the last 10 years, growing from strength to strength, and it's forecast to grow even further into the coming years. Now again, that all depends on the global stage and how everything sort of pans out. If peace is found and things become a little more stable, we'd have to keep an eye on the stock. Down to ownership, let's see who owns most of them. And institutions actually sits on 91%, with employee share scheme at 4.4%. We can see here that Capital Research Management Company, BlackRock and BAE Systems, that must be the employee share scheme, is actually third place. Okay, on to a bank. NatWest is the one we're starting with. They're up 12% this year. Ticker symbol NWG. Currently trading at £2.64. We can see at the start of the year they were £2.34. They had lows of £2.08 and highs of almost £2.81, and they've seemed to sort of level out at the moment at £2.64. Providing banking and financial services across the UK and internationally. Their snowflake is pretty solid. Solid track record with an adequate balance sheet, so That's all good news. Risks, unstable dividend track record. We'll look at that. And insider selling over the past 3 months. Okay, let's go see what is going on there. Pay ratio for this bank is 9.4, which compared to their other competitors, HSBC, they are slightly less and slightly more than Standard Chartered and Lloyds Banking Group. Barclays actually sits down at 5 and they're next, so we'll have a look at them. They are 51% undervalued on a DCF model, so fair value puts them at about £5.39. Future growth forecast at 8.7%. That's pretty modest. Let's see, free cash flow. Well, they're a bank. I need to kind of not look at that chart for a bit. We can see here going into December when their next earnings update is, and onward, things are looking pretty good. Now, again, these are speculations. Never take these as absolutes. Down to past performance, 24.9%. Yeah, NatWest didn't seem to be doing too good in 2016, but they got out of that into 2018, 2019. Had a bit of a slump over 2020 towards the end, but have recovered since. Financial health, I'd imagine, as being a bank, they're probably pretty healthy. Ooh, that's a lot of short-term liabilities. Again, it's a bank, so it's something, that's treated a little differently, but that's a scary debt-equity ratio. Oof. Right, so debt only 188 billion, but they do have 363 billion in cash in short-term investments. Again, their financial institutions analysis, it has to be looked at a little differently to other stocks. So do be sure, if you are using Simply Wall Street, link in the description, you can hover over these, and it gives you a wee bit more information that I might be providing, as this is just a quick overview. We can see their asset level to equity ratio is 22.9, considered very high, and they have a low allowance for bad loans. They do have some good points, though, such as an appropriate level of loans to assets ratio. Let's look at their dividend, 4.48%. It is notable, not very high, not very stable, and not growing, but it is covered by earnings and future dividend coverage. For their industry average, it's a bit above, and it's forecast to, 7.8% in 3 years? What? Let's see this chart. So they seem to have started paying back in 2018. Don't know if we can't see any further back than that. But they were paying a whopping 9.3% in October. They completely cut their dividend over COVID. Again, something to take a note of for any company that did that. In the 2021, they raised it and raised it again towards the start of 2022. And it's forecast to again grow in the next few years. Something to bear in mind. Let's go to ownership. We can see here nearly £1 million worth of shares was sold by 3 individuals. Again, nothing massive. Some people, take that as a real thing to note, but maybe it's an individual leaving the company. There is a lot of things to sort of look into that. But there you go. 3 individuals also bought shares at the same time, so something to bear in mind. Ownership breakdown, institutions but state or government actually own 47%. HM Treasury owns 46.98%. I think, was it NatWest they bailed out during their side? There's something about that, and I'm assuming that's why it's like mostly government ownership. BlackRock and Norges Bank Management is third. Barclays, another bank. Down 10%, ticker symbol BARC, currently trading at £1.60, market cap 25 billion, slightly below NatWest there. 1.76 is what they started the year, almost a £2, and you could have picked it up as low as 1.49 or 1.45 over the past 12 months. We can see here that they're an undervalued average dividend pair. I know a lot of people, really love Barclays as any of the bank stocks that they would pick, and I know they have a great platform for looking at investing. I know a few YouTubers use it. Value 5 out of 6 and dividend 4 out of 6. Something to bear in mind. We'll go on to have a wee look here. Let's go to valuation. Pay ratio, as I was saying, they are 5, so they're actually one of the lower of the banks for PE. We can see here that they're 37.6% undervalued. from £2.57 on a discounted cash flow model. They trade at £1.60, not 1.60. Future growth, a modest 2.6%, nothing massive, but at least growth is growth. Now again, something we'll have to wait and see, and December a lot of earnings come out so we can have a look at it. Past for performance, they weren't doing too well in 2016 and 2018, but coming through the pandemic they've went from strength to strength and have performed quite adequately in the last 2 years. Financial health, they have 969 billion in assets to 1.2 trillion in liabilities in short term. Ooh. Again, another very scary debt to equity ratio, but due to it being a bank, I think there's a whole lot more you can look into it with us. Cash and equivalents, as you can see, sits up. So it's not the chart. This chart is quite good for a lot of stocks, but for banks, you just have to look at it so much differently. Let's have a wee look here. We can see financial institutions analysis. Again, as I was saying, if you use Simply Wall Street, it gives you a wee bit of pointers on every single point here to help you understand what you are looking at. As we can see, it follows pretty similar to NatWest for asset level and allowance for bad loans, but it also has a low risk liabilities. 65% of Barclays liabilities are made up primarily of higher risk sources of funding. External borrowing, which is more risky than customer deposits. You learn something new every day, don't you? Okay, dividend yield 5.15%. Not too bad. Industry average, it's above and it's close to the market top 25%. It's forecast to grow quite modestly, 5.8% in 3 years. We can see by their chart here that their dividend yield has been up and down, as has been their dividend per share. I think they had a height there of about 5.2 before the pandemic, completely cut any dividends being given out and restarted them back in 2021. Ownership. They mostly owned by the state. No, they're actually owned by institutions. BlackRock, Qatar Holdings or Qatar, and Barclays Group Employee Benefit Trust, sitting at 4.62%. All right. On to CRH. They are a massive manufacturer and distributor of building materials, mainly concrete. They own quite a few companies over here in Northern Ireland. They own, I think they own Northstone and Farrens, if anyone is familiar with them. I think they definitely do own Farrens. They own Northstone. I know it's a CRH company. No, Farrens is a CRH company. Yeah, anyway, enough of some local culture here. We can see their ticker symbol is CRH. Pretty easy to remember considering their name is just CRH. Trading at 32.67 a share, 24 billion market cap, down 14% over the last year. They were trading at 38.13 and they had a low of about 30. Oh no, 28 was actually one of their lowest points. There you go, £28. Okay, they have a flawless balance sheet, a solid track record, and they pay a dividend. Now, they are forecast to decline on their earnings over the next 3 years, something again to note. Now, let's see here. Trading at 41% below their fair value, earnings grew 97%. I'll have to have a look at that. And they pay a reliable dividend, and analysts in good agreement, the stock will rise by 27%. Well, analysts sometimes just get it wrong, so I'm not going to hold that as gospel, but we'll see. 10.3 in the PE ratio, and we can see some of their peers. I don't think any of them are particularly in the construction industry. Could be wrong. I haven't looked into Breeden or Marshalls. Let's go down here to DCF. They are 43.5% undervalued, so £56.19 is their fair value, and they are 31.77 at the moment. When it comes to future growth, they are forecast to actually decline in the coming years. There might be a slowdown in the housing market, and building materials mightn't be as high demand. I know coming out of COVID, I think we can see they had a massive spike in earnings. Yes, there we go. Going from as low as, let's see, about 27 billion and then rising up to 32.8 billion in 2022 of June. Free cash flow, we can see they have about 1.7 billion in free cash flow as of June 2022. Financial health, they score 6 out of 6. Very rare that you would see any stock score 6 out of 6 and something. So what is it? Short term 16 billion to 9 billion, and long term 28 billion to 14 billion. They are in dollars, but close enough. Their debt equity ratio 46%. Nothing to be seen here. They almost have as much cash as they do debt. That's all good to see. Dividend 5 out of 6. So it's notable. It's not high. It is stable. It is growing. And it's got earnings coverage and cash flow coverage. Good to see. 3.15%. Pretty modest for most portfolios, I would say. It's lower than the industry average, but it is forecast to grow in the coming years. So we can see that their dividend per share from, I would say, 2016 has consistently grown. So that's about 6 or 7 years. And their yield has obviously fluctuated with their share price. Down to ownership, we can see that someone recently sold 2.1 million in shares, 62,000 of them. Ownership, mostly the general public and institutions. Wow, that's actually quite impressive. BlackRock, Vanguard, and Civian Capital are the 3 top owners of the business. Right, on to our last, the telecoms company. A lot of you will be familiar with this, Vodafone. They're a bit down in their luck at the moment, down 22% over the last 12 months. Ticker symbol VOD and trading at 86 pence. Started the year at £1.13. The highest point was about £1.40. And they are currently at their lowest that they've been in the last 12 months. They are considered a good value dividend stock with an acceptable track record. Financial health, not fantastic, but we'll look into all that. Let's go. Valuation. Their PE is 13. Let's see their competitors. Well, one of the stocks that I hold, Airtel Africa, actually has a lower PE, and BT even lower than that. Rogers Communications, I think that's the Canadian one, isn't it? 19.7, and China United Network Communications is 20.5. The more you know. I love learning about other companies just through this. That's why I love using Simply Wall Street. We can see here that they are 64.2% undervalued. Fair value is about £2.40 a share, and they're trading at 86. So something to bear in mind. Forecast. They are actually forecast to grow their earnings by 3.3% in the coming years. Past performance, they've had a few bad years. Not gonna lie, it hasn't been great for them. Even through the pandemic, it was also not great. And it was not even great going into the pandemic for Vodafone. Free cash flow, though, they still maintain a solid amount of cash flow available. So that's something to bear in mind. Financial health, their short term doesn't cover their long term, 30 billion to 34. Long term assets, 127 billion to 65 billion. We can see here that they actually had a modest 76% debt equity ratio in 2017, but that has grown to 114% debt equity ratio. Something to bear in mind, but they still have a good bit in cash and equivalents. Their debt coverage is also well covered by operating cash flow, and interest payments are also well covered. Let's go down to their dividend, 9.13%. This is why a lot of people love Vodafone. It is a high dividend pair when it pays, because it's not stable and it doesn't really grow that much. Industry average is 9.1. Forecast to still be 9.1 in 3 years' time. Some people like growing dividends. In other cases, their dividend per share has actually shockingly dropped over. It's basically halved in the last decade, and their yield has surprisingly continued to grow. It was for the same dividend per share last year, it was 5.8%. It is now nearly 9.1 due to the share price near enough collapsing. Down to ownership, we can see here that someone bought some shares recently, 129k worth, not too bad. Institutions own 80%, the public companies 11%, and general public is in third. Top one is Emirates Telecommunications Group, BlackRock and Vanguard sit second and third. And that is our next 5. Okay, who's next in the chopping block? Let's is it not letting me move? Oh, see if I click the right button, it would work. Who's next? In our next video, we'll have Ashtead, we will have Flutter Entertainment, Imperial Brands, SSE, and Standard Chartered. Nice to see. Oh, that'll be really interesting running through those 5. I'll catch us all over in that one. Thank you.